Welcome to the Engage with Your LGPS Pension series of webinars, which are designed to provide you with further information to improve your understanding of your pension in the local government pension scheme, otherwise known as the LGPS. My name is Richard Quinn, and I am one of your employer pension fund representatives that make up the employer relations team here at West Yorkshire Pension Fund. We are here to support employers in fulfilling their roles and help members in understanding the local government pension scheme and your pensions. Thank you for joining today's session, where I will introduce and explore today's topic of increasing your benefits, which will hopefully give you further information and aid in planning for your retirement. During today's webinar, we'll be covering the following topics. I'll give you an introduction to topping up your pension and introducing the two methods available to you for increasing your benefits. I will demonstrate how the two options work and what this means to your main scheme benefits and your income at retirement. Firstly, I will delve into APCs, otherwise known as additional pension contributions, explaining how they work, where to access information, and how to start an APC. And finally, touching on the main points you will need to consider if this is an option for you. Secondly, I will then delve into AVCs, which stands for Additional Voluntary Contributions, again explaining how they work, where to access information, and how to set up an AVC contract. And I will cover the key points to consider to aid in your decision making. I will briefly touch on shared cost AVCs, which are available to you if this is something your employer offers. And finally, I will make you aware of the additional resources you have to read up and research which option is the best for you should you wish to proceed with either one. For those who aren't too familiar with how your pension works or how increasing your benefits work, you may have the question on your minds, can I increase my contributions to get more pension? The answer is not an option to increase your contribution rate that is deducted each month in your payslip, which to get more benefits and ultimately build a bigger pension pot. The way your pension builds up and the contribution rate that is deducted from your pay each month is set out in the regulations, and you cannot elect to just pay more. It all works on your annual rate of pay, and your contribution rate will only change if your pay goes up or down. However, the good news is that there are two ways available to you in which you can pay more to increase your overall benefits at retirement. And we will look at these in more depth in the upcoming slides. The first option is APCs, which stands for Additional Pension Contributions, and is a way of increasing your actual overall main scheme benefits and increases the annual pension you build up in the LGPS. The second option, AVCs, stands for Additional Voluntary Contributions. This is separate to your main LGPS benefit and is set up with a third-party provider and is a separate pot that you build up, which you can access at retirement, so when added to your LGPS pension, will increase your overall retirement benefits. Before we delve into and explore the two options for increasing your pension benefits, I just want to run through and remind everyone how their pension benefits are calculated and built up, and then this will help to understand how the two options impact your benefits. Depending on when you join the scheme, you can have a combination of what is known as final salary membership if you joined before the 1st of April 2014, and care pension for anyone in the scheme or joined from the 1st of April 2014. Pre-1st of April 2008 final salary membership, which built up as an accrual rate of 1/80th, and that is based on your final pay and membership of the scheme in years and days. There's post 1st of April 2008 to the 31st of March 14, again as final salary membership, which built up as an accrual of 1/60th, based on your final pay and membership of the scheme in years and days. Post 1st of April 2014, known as care pension, and this builds up as a 49th of your pensionable pay or a 98th if you are in the 50/50 scheme. So if we use John as an example on the slide, he joined before the 1st of April 2008, so he has pre-1st of April 2008 membership under final salary. This builds up based on his membership times his final pay and divided by the accrual rate 80. John's membership in the scheme up to the 31st of March 2008 times his final pay and divide by an 80th gives John an annual pension of £397.12 and an automatic tax-free lump sum of 3 times his pension of £1118.41. The scheme provisions at the time provided members with an automatic lump sum. John has continued contributing to be in the scheme. The scheme is still classed as a final salary scheme, but there were changes with effect from the 1st of April 2008. The formula for calculating your pension is still the same. The only difference is that the pension benefits built up at an accrual rate of 1/60th. But there is no automatic lump sum. A lump sum would only be available if you were to convert some of your pension to provide a tax-free lump sum. So again, we take your membership in the scheme in years and days, times that by your final pay, and divide that by an accrual of 1/60th. So in the example, John has built up an annual pension in the 60th section of the final salary benefits of £3,176.94 per year, and no automatic lump sum. This is then added to the benefits accrued under the 80th section, so that's the pre-1st of April 2008, to build up your annual pension payable at retirement. From the 1st of April 2008, changes to the scheme means there is no automatic lump sum provided with the benefits, but you do have the option to convert some of your annual pension to provide a tax-free lump sum. So for any members who joined on or after the 1st of April 2008, won't see an automatic lump sum shown in their benefit statements. John remains in the scheme, and we now reach the section of your pension referred to as Career Average Revalued Earnings, otherwise known as the CARE scheme. This change to the scheme was brought in with effect from the 1st of April 2014. Any active member of the scheme at that point automatically was entered into the CARE scheme and started building a pension pot up as a 49th of their annual pensionable pay. Any new members of the scheme who joined after the 1st of April 2014 were also put into the CARE scheme. This means your pension builds up as a 49th of your pensionable pay each year you're in the scheme. So if we look in the example with John, he has built up an annual care pension of £11,346.24, which will be added together with the pension accumulated at an 80th and a 60th under the final salary membership to provide John with his total annual pension. In this example, we've based John's care pension on the fact he started on an annual salary of £25,000 and assumed a 1% increase in salary each year, and the care pension has been revalued each year for inflation of 1.5%. All the figures are provided for illustrative purposes only. When we calculate John's annual pension payable at his retirement, it is the culmination of the benefits built up under final salary membership, encompassing the 80th, that's the pre-April 08, the 60th, the post-April 08 to the 31st of March 2014, and the care benefits at a 49th from the 1st of April 2014 to the date of leaving. So if we add the £397.12, the £3,176.94 and the £11,346.24, this provides John with an annual pension of £14,920.30 and an automatic tax-free lump sum from his 80th final salary benefits of £1,108.41. Now, if John was to set up an APC contract to purchase the maximum amount of annual pension of £7,579, this would increase the annual amount of pension of £14,920.30 as demonstrated on the next slide. So the way the APC works is that the amount of pension you decide to purchase increases the annual pension you are entitled to at retirement. It is effectively topping up your main LGPS pension pot. As you can see, if we add the additional pension purchased of £7,579, which is the maximum annual pension which can be purchased, this increases John's annual pension to £22,469.30. It is important to understand that the £7,579 of additional pension is not the cost for providing this additional pension. I will explain this further through the slides when we explore the APCs in more depth. The second option available to you for increasing your benefit is an AVC. It is important to remember this is a separate pot to your main LGPS pension benefits, and the value of your AVC pot is dependent on the investment returns and how they perform over the lifetime of your AVC arrangement, and the value of the AVC pot at the point of retirement. Different to how the APC option works, this doesn't directly impact your LGPS benefits and increasing the annual amount of pension payable from the pension linked to your employment. What it does will mean you have boosted your overall total retirement income, so effectively adding the two values together of your AVC pot and your main LGPS benefits. That hopefully provides a simple explanation of each of the options available to you and demonstrates how they will come into effect at your retirement. I'm now going to explore each of the options in more depth, explaining in more detail how they work, what steps you would need to take to set up either an APC or AVC, and the key points you need to consider for each one. It's important to reiterate here that West Yorkshire Pension Fund cannot provide any advice as we're not authorised to do so. If you need advice, you will need to seek advice from an independent registered financial advisor and decide which option is best for you and your circumstances should you wish to proceed. The first option available to you to increase your benefits at retirement and provide the level of income in line with your plans is an APC, which stands for Additional Pension Contributions. As explained earlier, this method will purchase additional annual pension in the LGPS pension scheme that is linked to your employment. To set up an APC contract to buy additional pension, you must be in the main section of the scheme. All new members are contractually entered into the main section of the care scheme, and it's only following an election from you as the member to move into the 50-50 section. If you are in the 50-50 section, you are not able to set up an APC contract. An APC allows you to increase the annual pension by a maximum up to £7,579. This is the figure as of April 2023 and will be adjusted in line with inflation. Once an APC contract is set up, the additional contributions are deducted in the same way that your normal pension contributions are deducted from your pay each month, and this means you will receive further tax relief. This is providing you are a taxpayer, as both your main scheme and additional contributions are deducted prior to the tax being calculated. You can decide whether you wish to pay the cost of the APC contract as regular instalments or to be paid as a one-off lump sum. Please note, if you do decide to elect for the lump sum option, you would need to claim the tax back through a self-assessment. and for regular instalment payments must be at least £10 per month. APC contracts are set to run for whole years. So that's 1 year, 2 year, 3 year, up to 30 as an example. But the maximum is the number of years to your normal pension age. The shortest period you can pay over is 12 months. And if you're less than a year from your normal pension age, you can only pay by lump sum. For any members who hold more than one pension record, as a result of holding more than one employment with your employer, you need to make a separate election for each role or specify which of the roles you are paying APCs on. The additional pension you are purchasing is only in respect of your members' benefits and does not provide for survivors' benefits. You can only take out an APC contract if you're an active member of the scheme, so this means you are actively contributing to the scheme and haven't opted out of the scheme or hold a deferred or frozen benefit. Any APC contracts you have set up will cease when you reach your normal retirement age or if you leave that employment. In addition, the APC contract will cease if you join the 50/50 scheme. So for any members who do have an APC set up and are then considering moving to the 50/50 section of the scheme, will need to have consideration of this before you make your election. If you are considering proceeding with an APC, then I will now cover the steps of what you need to do to set up an APC contract. First of all, you will need to access the APC calculator tool. This will allow you to work out how much extra pension you want to purchase and what the cost will be for purchasing the extra pension. This will allow you to look at whether you wish to pay by regular instalments or as a one-off lump sum. It's important to remember here that the contributions are based on your age and the period over which you are purchasing the pension. The calculator tool can be accessed via the link on the screen and is provided by the Local Government Association on their LGPS members website, which also holds a wealth of information to help you understand your LGPS pension further. The method of payment is also the same way you would buy back any periods of lost pension where there is a period of unpaid leave. The additional pension purchased via an APC will be reduced if the pension is taken before normal retirement age, with the exception of ill health retirements. Once you have clicked on the link, you will be presented with the Tools and Calculators section of the LGPS members website. Under the Buying Extra Pension Calculator section, please click the Calculate Extra Pension Contributions button. You will now be asked to complete the online form to provide some details. Each of the boxes are marked with an asterisk to denote a required field needs completing, and the question marks can be clicked to offer further guidance. In the first box, there is the gender. Select the drop-down box and click the appropriate option. The next box is date of birth, so click on the calendar icon at the end of the field and use the drop-down arrows to select the appropriate year and month. This will then allow you to then select the appropriate date from the calendar. You'll then be asked to select the section of the scheme. You are only allowed to set up an APC if you're in the main section of the scheme, so select the appropriate option. If you select 50/50, it will not allow you to proceed. The next field is percentage your employer has agreed to pay. So if your employer has agreed to contribute to an APC contract, the agreed upon percentage will need to be entered here. Finally, select the appropriate radio button on how you want to pay either regular payments or lump sum, and with all the fields completed, click Continue. If you have chosen regular payment in error rather than lump sum, you can change the payment option here using the drop-down arrow next to regular payment. We are going to stick with regular payment for this example. You now have the option to either choose how much I want to pay, so this is the total amount you want to pay, and when you click calculate, this will tell you the total extra pension this will buy you. In this example, we're going to choose how much extra pension I want to buy, and we're going to go with £1,000. We're going to state we want to pay monthly, and the period we want to pay it across is 1 year. Now, click calculate and we wait for the results to be shown. As per earlier, we advised the earlier the cost is based on your age and the period you're paying it over. So we've done a comparison of someone who is aged 23 and someone who is aged 53 just to show the differences in the costs. In this example, for a male aged 23, if we look at the cost for purchasing £1,000 of extra pension, so this will increase the annual pension at retirement by £1,000. The regular cost before tax relief is £527.60. It will also show you your current normal pension age. So this will have been based on your date of birth. So this will differ from member to member. The regular cost of £52.76 before tax relief per £100 of extra pension. In this next example, for a male aged 53, if we look at the cost for purchasing £1,000 of extra pension, so this will increase the annual pension at retirement by £1,000. The regular cost before tax relief is £1,036. Again, it will also show your current normal pension age, so this will have been based on your date of birth that you've input, so this will differ from member to member. So the regular cost, this would be of £103.60 before tax relief per £100 of extra pension. So it's just to see the difference that the cost to someone who's age 53 and someone who's younger at age 23. This brings us to the end of the APC option. So what I would like to do now is just cover some of the key points you will need to consider in deciding whether this is the option for you and your circumstances. An APC purchases additional pension benefits within the LGPS. So this increases the annual pension you're entitled to. You know what you are getting to normal retirement age. There is no uncertainty or reliant on other factors. The pension is guaranteed and index-linked income, so this means it's inflation-proofed and will be payable for life. It is inflexible, so it's purchasing a set amount and the cost is set payments of choosing regular payments or paying by a lump sum. It is more expensive the later you start, so we always advise members it is never too early to start planning for your retirement and having an idea of the life you want to live when you retire. The value of the benefits is reduced if you retire before your normal pension age, unless you retire on the grounds of ill health. You may be required to provide a medical report or certificate, but this will be confirmed as part of your application. In the event of your death prior to claiming your APCs, there are no death benefits due from an APC. This only buys pension for you. The next section of this presentation will now introduce and explore the second option available to you to increase your pension benefits, known as AVCs, which stands for Additional Voluntary Contributions. As advised at the start of the presentation, this option is separate to your main scheme benefits, as demonstrated earlier, and it's arranged through a third-party AVC provider that your pension fund has elected to use. The contributions are deducted from the pay in the same way as your normal main scheme contributions and are subject to tax relief. Those contributions are then paid to your fund's AVC provider, who will then manage the investment of those funds based on the options you have selected from the available investment options. Please note that tax savings that you receive are higher if you are a higher rate taxpayer. The contributions you can elect to be deducted as either a set amount each month or as a percentage of your salary. AVCs have greater flexibility when it comes to the contribution amount and can be varied as your circumstances change. So these can also be stopped and restarted as you choose. There are several factors that can influence the performance of your AVC fund, and as your AVC pot is invested, this does mean it can go down as well as up, depending on how well those investments perform. When setting up your AVC plan, you can choose how your AVC is invested according to your attitude of risk. You can select low risk, which is low reward, medium risk, medium reward, or high risk and high reward. At the point of your retirement, your AVC pot can be used to buy additional pension in the LGPS, used to buy an annuity with the AVC provider or on the open market. An annuity is a way of turning your AVC pot into a secure income that will be paid in addition to your main scheme benefits annual pension. Subject to HMRC limits, your AVC pot can also be paid as a tax-free lump sum. The value of your AVC fund at retirement will depend on how much you have contributed, as well as how the funds have performed over the years and on the market at the time of your retirement. If you die before claiming your AVC, this fund will be paid in line with your death grant nomination for your main scheme benefits. This brings us to the end of the AVC option. So what I would like to do now is just cover some of the key points you will need to consider in deciding whether this is the option for you and your circumstances. There is greater flexibility when it comes to your contributions and can be tailored to your own personal circumstances as they change. You are in control of the cost contributions by deciding how much you wish to contribute by either specifying an amount or a percentage of your pay. So for example, you could select £100 per month or decide to do 3% of your salary. The benefits are not reduced for early retirement, and there are a number of options open to you with regards to what you do with your AVC. You can increase your tax-free cash at retirement, use it to increase your income at retirement, or a combination of both subject to the limits set by HMRC. In the event of your death, the AVC fund is paid as a lump sum to your death grant nominee. The main point you need to bear in consideration is that an AVC is not guaranteed like your main scheme benefits, so you won't know exactly what you get at retirement. This will depend on how your fund's investments perform. Market fluctuations can influence the value of your AVC fund, the amount you contribute. Have you gone for a higher level of risk and reward or chosen lower risk, lower reward? Which means the value of your fund can go down as well as up. And the value of your fund takes all this into consideration at the point of your retirement and you access your AVC. To access further information on AVCs, you can visit the www.wypf.org.uk website, and you can either hover your mouse over the Active tab along the top, and from the sub-menu that displays click on Paying Extra. Or two, you can click on the Active Member Central tile, then select All About Your Pension, and then scroll down to the Contribution section and click on Paying Extra. From here, you can access further guidance in the way of the AVC fact sheet, or by clicking on the AVC options at retirement for active members or deferred members links, which will take you to a dedicated page with further information regarding what your options are at retirement for your AVC. If you scroll down to the bottom of the page, there is the necessary link to take you to more information about the AVC provider for your specific pension fund, and the contact details for contacting the AVC provider to discuss your options further and set up your AVC arrangement. When accessing the AVC provider website, you will be prompted to confirm your scheme name. Please note West Yorkshire Pension Fund administers the scheme on behalf of Lincolnshire, Hounslow and Barnet pension funds, but it is also the name of the pension scheme for any members who fall under employers in West Yorkshire. We appreciate this may cause confusion, so you need to ensure you select the correct scheme name. If you are unsure of your scheme name, if you access your annual pension statement, the logo will appear in the top right. So for example, if you're in the West Yorkshire Pension Fund, you'll see the West Yorkshire Pension Fund logo. If you are in the London Borough of Barnet Pension Fund, you'll see the London Borough of Barnet logo. If you're in the London Borough of Hounslow Pension Fund, you'll see the London Borough of Hounslow logo. And if you fall under the Lincolnshire Pension Fund, then you will see the Lincolnshire Pension Fund logo on your annual benefit statement. Once you have selected the relevant scheme, you will be asked to select your employer from a drop-down list and then click Proceed. So once you've selected the scheme and the employer and click Proceed, you will then be presented with the page where you can find further information on all about the AVC plan and covering topics such as understanding your AVCs, what's an AVC, tax savings, flexible contributions, your investment choices and what options are available to you, how much control you want. You can also then click on the new customer looking to apply and click on the apply for an AVC plan if you've read up on all the information and have now made a decision to apply for your AVC. As mentioned earlier, contributing to an AVC plan brings additional tax relief. So the higher rate of taxpayer, the more tax savings you will see. If we use the example on the slide of a 20% rate taxpayer, what this means, if you decide your contribution is going to be £100 per month, the actual cost to you would only be £80. This is if you consider the tax savings, so you're saving £20 on the level of tax you would normally pay. The tax savings doesn't increase the amount you contribute into the AVC fund. If you decide to invest £100, then you are still only investing £100. The tax relief means that the £100 is deducted before tax is accounted for. Therefore, this will reduce the level of tax being deducted. The extra savings then don't go towards your investment. We're now going to have a look at an example of retirement benefits with AVCs. So through your AVC provider, you do have access to the tools to illustrate the tax relief you could get on your pension contributions using the income tax calculator and look at how your monthly pension contributions could add up in retirement through the retirement contributions calculator tool. The figures are only a guide based on the details you enter, so considers percentage of salary you contribute, i.e. monthly contribution, salary, number of years you contribute for. So we're now going to look at an example for a retirement contributions calculator just to demonstrate how it works. Using the example on the slide, if a member was earning £20,000 per year, is a non-Scottish taxpayer, the pension pot starts at 0 and contributes for a total period of 5 years. So the contributions that will be made are based on a 3% contribution rate, which costs £40 per month. Let's see what this would mean to an estimated pension pot value. The first part is the total cost to you. So this is the amount based on the percentage of salary and the number of years you have contributed. So this is the amount that will come out of the pay each month, and for the total of 5 years amounts to £2,400. The next part is the total amount that goes into your pension pot based on your contributions and amounts to £3,000. This demonstrates the amount of tax relief that you would receive on the total contributions of £3,000. Because of the tax relief that is applied to the £3,000 you've contributed, it hasn't cost you £3,000, it's only cost you the £2,400, as you've received £600 on tax savings. The total potential growth of £338 is the amount based on the percentage of salary and number of years you contribute, plus any growth in your investments less charges. This then provides the total estimated pension pot value is based on the percentage of salary, the number of years you contribute, plus tax relief on your contributions, and the total growth in your investment less charges. So that amounts to £3,338. An alternative option potentially available is a shared cost AVC. However, this option is only available if your employer has decided to offer shared cost AVCs. Not all employers do, and it's not a decision made by the pension fund. This is at the discretion of your employer. So please contact your employer to see if this is an option they offer. Shared cost AVCs enable you to build an additional pot of money alongside your pension with contributions exempt from both income tax and national insurance contributions, with the potential to take it all as a tax-free lump sum when you retire. The AVC contributions are then paid to the AVC provider and taken from the employee's net pay via salary sacrifice, on which the employer also makes savings by paying less employer national insurance. As it's a shared cost AVC, the scheme must be operated on a shared cost basis, so you will be required to pay £1 per month as your contribution to the shared cost AVC arrangement. Your employer pays the rest of the value you decide to pay into the pot, but your salary is reduced by the amount of the AVC contribution that your employer makes on your behalf, and this is called salary sacrifice. So for example, if you pay £100 per month, £99 being the salary sacrifice amount, and £1 being your personal contribution. The benefit is that both you and your employer pay less in national insurance contributions. Now I would just like to demonstrate the additional tax relief. So again, the higher rate of taxpayer, the more tax savings you will see. Unlike a standard AVC plan, a shared cost AVC plan, you pay reduced tax and national insurance earnings. So if we use the example on the slide of a 20% rate taxpayer, what this means is if you decide your contribution is going to be £100, the actual cost to you would only be £68 if you consider the tax savings. So you're saving £32 on the level of tax and national insurance you pay. The tax and national insurance savings doesn't increase the amount you contribute into the AVC fund. So if you decide to invest £100, then you're still only investing £100. The tax and national insurance relief means that the £100 is deducted before tax is accounted for, so this will reduce the level of tax and national insurance being deducted. The extra savings then don't go towards your investment. If you require any further information on either of the options for increasing your benefits, please visit the Paying Extra section of our website and read through the key points to familiarise yourself with the key details and what this could mean for you at retirement. Just want to make you aware of further points for consideration. So additional benefits are only payable at the same time as your main scheme benefits. You need to look at and consider your options and check out the APC calculator to give you a better idea of the cost and options you wish to proceed with. You will need to consider the information to decide which is the best option for you. West Yorkshire Pension Fund cannot provide any advice, so we do recommend seeking independent financial advice from an authorised independent financial advisor. For anyone who is considering retiring soon, if so, then this might be interesting in joining one of our partners' pre-retirement planning sessions online. They will help you keep retirement plans on track and to start planning early. These courses run all year, so please check our website for the dates so you can book on the course. I would also just like to make you aware of some of the additional resources, so which I've already referenced, that are available to aid your understanding in your pensions journey. The West Yorkshire Pension Fund website, which is our own scheme-specific channel with lots of scheme-specific information and where you can register for My Pension. There's the Retirement Living Standards website to plan for the future provided by Pensions and Lifetime Savings Association, the PLSA, pitched at 3 levels of retirement models: minimum, moderate and comfortable, based on a basket of goods and services from food and drinks to holidays. There's the Money Helper, another site which is useful, provided by the Money and Pension Service, which in itself is a body sponsored by the DWP, with a wider range of financial information, and it's home to the Pension Wise service for advice and guidance, which you can book with them. And finally, there is the LGPS members website, which is provided by the Local Government Association, otherwise known as the LGA. There's more national scheme resources, including calculators, and it's home of the pensions account modeler, which was mentioned earlier, to work out if you're the cost of purchasing extra pension. And in terms of support that we can provide here at West Yorkshire Pension Fund, if you have any specific scenarios you're struggling with or still require some assistance, then please do get in touch with our customer service team at our contact centre, who will assist you. The details are displayed on the slide here. You can contact us via email on the contact centre team mailbox or call the contact centre helpline for assistance. Finally, we have a wealth of information on our website at www.wypf.org.uk. And this is again where you can register for My Pension as well. Before I bring the session to a close, I would just like to carry out some administration duties and read through the disclaimer on the screen. This presentation has been issued to you by the West Yorkshire Pension Fund, known as the Fund. This guidance has been prepared on the Fund's current understanding of the scheme regulations, therefore should not be treated as a complete and authoritative statement of law. Users may wish or will need to take their own legal advice on the interpretation of any particular regulations. No responsibility whatsoever will be assumed by the Fund for any liability, financial or otherwise, incurred by stakeholders relying on this statement. The Fund does not accept any responsibility or reliance on the contained or referred to in this guidance. Thank you very much for joining me today, and I look forward to seeing you on our future webinars.